I've got a statement here from a user that watched my previous video about how a user was asking that if you use money from an offset account that's linked to your own occupied and then use that money to purchase an investment property, whether that was tax deductible. I said it isn't. However, this user provided a statement and I'm trying to be very objective. I'm not going to troll this user. It's just for information purposes. This user is saying, no, actually it is tax deductible. Any funds withdrawn from the offset is tax deductible for investment purchase. This user is saying it's the purpose, not the security, that determines the tax deduction. Now again, I'm being very respectful, very diplomatic. I'm not trying to troll this user, but I don't think this information is correct and I'll show you why. What this user is basically saying is that if you have a offset account that's linked to your, for example, your own occupied, which has 500k for lending, and then you use these funds to buy an investment property, this is actually tax deductible based on the comments saying that it's based on the purpose and not the security, which I don't agree with because I researched it on the ATO community and I did a bit of digging and it says it here. There was a user that asked the same question. If you have an owner-occupied property 1 million and he has 500k in offset, and if he used 300k for deposit, which is basically the same scenario here, he's asking, keen to know whether you can claim the tax return for the interest charge for the 300k he took from his offset account. And you want to know what the ATO said? Now scrolling down to Judy from ATO, it says here, what we look at is the use of the borrowing and where the money originated from. Now you advise the amount of 500k in the PPOR and there's 500k in the offset account. Now she says any amounts removed from the offset account are not deductible, as the offset account is just a personal savings account being used to reduce interest calculation. They don't form part of the loan, so they are not tax deductible. However, if the individual borrows an amount directly from the bank and uses it to provide accessible income, then the interest component of the loan is tax deductible. And that is why when you have a 500k home loan, to use this 300k, you have to restructure it in a way where you split the loan up and then you Phoenix the 300k, so that becomes zero, and then you only owe 200k, and then you re-borrow with the new bank a new fresh 300k, and that is for investment purpose. Therefore, the funds you use is not seen as taking it from your offset slash transactional account. It is now seen as a new loan because the old loan has died and Phoenix from the ashes become a new loan, and that becomes tax deductible. Again, not financial advice. I'm not a tax lawyer, but I'm only quoting from the ATO and the ATO community that has raised that question. And I'm sorry, this user, you are incorrect. Again, there's no trophy for being right and wrong. I'm just trying to address this to enlighten you in this situation. I'm also using this opportunity to address others who think like yourself, and therefore you don't run into any troubles with the ATO in the future. Jump in the comments and let me know what you think.